From October 27th to November 8th, U.S. 5-year Treasury yields rose from 4.08% to 4.4%, falling slightly short of eclipsing the 15-year high of 4.45% established on October 20th. Now, this rally has been interesting in that it seems to be driven by two economic data points that appear, at least on the surface, to contradict the prevailing narrative of a slowing economy. On October 27th, U.S. GDP numbers showed a rebound from previous reads, posting a better than expected 2.6%. Now, detractors argued that the number was pushed higher by exports, inventories, and government spending, which potentially masked a number that was closer to recessionary. And then on November 4th, we saw a non-farm payrolls number, which was also higher than expected, but disagreed with the household survey and showed some disappointing full-time employment. Despite the two-sided arguments surrounding the data, 2-year Treasury yields made new recent highs, but the 10-year Treasury yield fell short of making highs. Now, the 5-year tends to be an inflection point between short-term rates that are more directly controlled by Fed policy and long-end rates that rely more on market dynamics. Now, if a trader believes that 5-year U.S. yields could rise from here, they could express that by buying the November micro 5-year Treasury yield futures contract at 4.34 and target a move to the psychological level of 4.75. A stop for this trade could be placed below at 4.10. This trade could make $410 if the target is reached and risks $240 if you're stopped out of your level. Now, if a trader believes that yields could fall from here, they could sell that micro November 5-year Treasury yield futures contract at 4.34 and target a move back to 4.00. A stop for this trade could be placed above at 4.54. Now, this trade could make $340 if your target is reached and risks $200 if you're stopped out of your level.